Welcome to today's sector update video, where we look at important trends, challenges and opportunities shaping key sectors. Today we are joined by Shibani Kurian, Fund Manager and Head of Research, who will present us with comprehensive viewpoints on these industries.
Hello, hi.
Well, to begin with Shibani, you have been overweight on capital goods, manufacturing and infrastructure sector. So what are the key areas driving growth in these sectors?
So absolutely. So this is a segment that we have been overweight and positive on for a while. Even if you look at the recent trends and the union budget being an example, the budget clearly sets out growth in terms of capital expenditure at about 17%, which is a fairly healthy number to go by. The public sector capex has been driving growth both at the center and as well as the state level. And our expectation is that given capacity utilization levels currently, the private sector capex is also on the cusp of improving. There are new areas of investment, whether it be green energy, battery storage, hydrogen. These are also likely to drive capex going forward. And hence, this is a sector where if you look at trends in terms of order book and some of the companies that have reported numbers recently in the Q1 numbers, order book continues to remain fairly healthy and strong. That means the growth trajectory is fairly good as well. And hence our belief is that, of course, keeping in mind valuations, this is a sector that we continue to be positive on.
Moving on to automobile and auto component sector, Nifty Auto has given almost 70% return in the past 1 year. What drives this growth? And what do you think? Where is the next leg of growth is coming from?
So absolutely. So if you look at the entire auto components piece, this sector has outperformed. So post-COVID, we saw revival in demand. A lot of that demand came in the premium segment, especially the SUVs, and therefore there was a large amount of growth that came through. This also coincided with a period where commodity costs were under control and therefore margins also expanded. Now, incrementally, if you look at what's happening in the auto OEM space, the rural segment or the mass segments which were lagging now are showing signs of improvement. One case in point here is the two-wheeler space, where we have started seeing improvement in terms of volume growth. And therefore, if you look at the entire auto OEM space, the two-wheeler part is something that we are positive on, specifically coming on the back of improvement in terms of rural income and growth and demand in that particular category. Where auto anchs or auto ancillaries are concerned, again, they derive a lot of the demand coming in from growth on the OEM side. And also what we've seen is that the components per vehicle in terms of the overall pie, that has also been increasing and that is driving growth, which is why in the auto ancillary piece, we are overweight across our portfolios.
Next, what are your views on the consumer sector? How has the volume growth been in this sector, and how do you think is rural consumption shaping this sector?
Yeah, so the rural piece, again, when we're talking about consumption, post-COVID, while higher end consumption or premium consumption revived and has been growing fairly well, the lower end mass and rural consumption has clearly been lagging. And therefore, wage growth, specifically in the rural segment, has also been lagging, and that has resulted in muted outcomes. But now, incrementally, a few data points make us believe that one, rural income is likely to improve. One, from a policy perspective, government is focusing on the rural space, and you've seen some push in terms of that segment. Even in the budget, there was an outlay for the rural sector. Second factor is monsoons have been good, and therefore the expectation is that the Kharif crop production will also be better vis-a-vis last year, which should again drive rural income. So our belief is that if you look at consumers, specifically where companies are deriving demand from the bottom of the pyramid or from the rural segments, they should start seeing improvement in terms of volume growth. If you look at commentary that has come from some of the companies, again in the first quarter earnings season, some of the companies are pointing out to the fact that there is some degree of revival in the rural space, albeit at a slow and steady pace. And valuations in this segment, especially when you compare it with long-term historical averages, are fairly reasonable. And therefore, incrementally, this is a space that we are focusing on.
Lastly, let's discuss about financial services sector. The loan growth has remained healthy and the mutual fund AUM is also on the rise. So what do you think? What areas would see a positive impact in this sector?
So there are a lot of positives where financials are concerned. One, the sector itself, as you said, has been fairly diverse. You've seen mutual fund AUMs rise. Loan growth has been holding up well. Asset quality trends for most of the banks have been fairly benign and credit costs have been under control. However, when you look at the sector today, especially the banks, what is basically changing in terms of focus area is liabilities and deposits. So deposit growth, as you know, has been lagging loan growth, and incrementally banks are now required or are looking at increasing their deposit growth trajectory to match the loan growth demand. So therefore, in this sort of context, banks which have a healthier retail deposit franchise, which have a wider presence in terms of branch network, are clearly better placed. Some of the private sector banks have done fairly well. They have gained market share both in terms of loans and deposits. These large private banks have also seen improvement in profitability over the last few years in terms of their return ratios. Most importantly, when you look at valuations in the sector valuations specifically for some of the larger banks is trading at multiples in terms of price to book, which is much lower than their long-term average. So while there are some near-term headwinds in terms of deposit pressure and therefore higher cost of deposits, but when you look at profitability and valuations, they clearly are favorable and risk reward is in your favor, which is why we believe that private sector banks, specifically the large private banks, is a place that we can incrementally look at.
Thank you for all these insights, Shibani. It seems there are plenty of opportunities for investors to invest in the coming months before making their sectoral choices.
Thank you so much. My pleasure. I believe that we should continue with our disciplined approach to investing. So stay safe, stay invested. Thank you.
Thank you all for tuning in. To know outlook of all the sectors, visit kotakmf.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.